Okay, good morning, everyone. Welcome to the trade buyings and adjustments for Thursday, the 21st of April. Kind of a sparse crowd today, but I do have a lot of your emails that I'm doing my best to go over and to answer for you. So one of the questions that was asked via email was, what ever happened to the risk of the war in Ukraine, right? And it's funny because we don't hear it right now. It's gone. 3-4 weeks ago, it brought our market down 15%. Today, in a Bloomberg 5 things that you need to know about today, boom, I got hit with this. Mariupol seized. President Vladimir Putin said Russia has liberated, which, conquered Ukraine's city of Mariupol, apart from the massive, I don't know how to say that, but steel plant, which he ordered a blockade. Kyiv has called for urgent talks to save the lives of fighters and civilians in the city. Russia also said it test-fired a new intercontinental ballistic missile and a warning to the U.S. allies. Russia's race to avoid default escalated after derivatives panel said ruble repayments of interest on the country owed on $2 denominated bonds were a potential default. So here we go. In today's news, nothing is being stated about Ukraine. And the fact of the matter, and pardon the way I'm going to say this, Steve, because I know you've asked this question a couple times, and I think Peter also asked this question, and you post all your stuff on Facebook about it. The market viewed, and I don't mean this, I don't justify it, but the market viewed the Ukraine war as a fad. It's a passing fad. That's all it is. So plain and simple, the fad of the Ukraine war, even though it's tragic to Ukraine, Russia, they're losing tens of thousands of lives. It's just seen as a fad for the markets. It's not important. Neither country is important on a global scale of anything. But Kevin, the nickel in Ukraine and gas and oil and wheat, this is showing you that all of those big headlines, it was just news-driven scare BS. There's enough nickel to keep making what we make computer-wise. There's enough wheat in the world, especially in the United States, that it doesn't really matter. Yet the news 3-4 weeks ago, with wheat, we're doomed. Wheat prices, bed prices are going to go through the roof. That just wasn't true. And so it's I don't know how you've heard me say it, but plain and simple, it's so important to do your own research. It's the internet, for hell's sakes. It's the internet. It's TV. For the most part, it's not real. Anyone can say whatever the hell they want to say. If you believe every word on the internet, I need to scratch my head and go, what are you thinking? Because that's not real. Anyone can put anything on the internet. It's what we do here. We give our best judgment. We're not always right. And the fact of the matter is, we can put anything we want to on the internet. And that doesn't make it right. It doesn't make it true. And if you can scare people and put more BS in there that really freak people out, that's how stuff goes viral. That's how you get paid more. And basically, you're getting paid more for creating a crock of crap, right? So, a couple of you emailed me and asked, what about the war? How come it's not important? How come it's not being said? How come it's not affecting our market? How come, Kevin, you called it a buy opportunity? And where were your morals, Kevin? How come you didn't give a crap about a country that's being invaded? And it's like, wait a second. It's not that I didn't give a crap. I just said it truly has no real effect on our markets. Well, Kevin, it dropped our markets down 15%, which it did. And I guess that was real. But looking a farther out in time, I didn't know it would be a month. But looking a month out in time, it really doesn't matter. So, Peter and Steve, I know you guys are big on putting stuff out on Facebook in regards to this, and you've got comments about it, and you're worried about it. And I'm not saying you shouldn't. All I'm saying, it's not a big enough piece of the U.S. stock market that it matters. And I'm not saying the people there, the atrocities there don't matter. I'm just saying it doesn't matter in regards to our stock market. It just isn't important enough. So with that said, guys, you've got to do your own research. You've got to crunch your own numbers. Don't believe the crap you see on the internet or the stuff that's just thrown out there. So with that said, it's time to look over what's happening in the portfolio and reevaluate portfolio positions. What are your thoughts? I mean, you guys know our core holdings. In fact, if I'm just to state or restate our core holdings pretty quickly, my comment is, how do I say this? How, let me rethink this, but no, I'm going to say it anyway. I want you to look at our core holdings. I want you to poke a hole in any of the companies you think aren't a good long-term investment and can't make it through short-term volatility. We have Apple, we have Boeing, we have Bank of America, we have Baidu, we have Disney, we have Ford, we have Facebook, we have Micron is becoming a core holding on technology side. We have Square as an alternative financial, Target, Under Armour, Visa. Those are pretty much our core holdings, right? So what are your thoughts from you guys? What are your thoughts in regards to those core holdings? What do you worry about them? I mean, let's face it, what are you worried about? And, that's an interesting one. So I'm going to say thoughts from you guys. Some of these stocks suck right now. Correct. If William was here today, he'd say that too. But that wasn't my question. My question was, are you worried about these companies going out of business? Are you worried about these companies making money? Are you worried about these guys having a higher strike price in the future? Are you worried about them not bouncing back? And again, to kind of go through this list, right? Apple, Boeing, Bank of America, Baidu, Costco's been one of ours. I didn't mention that earlier. Disney, Ford, Facebook. I'm just kind of scrolling through. JP Morgan is one of them. Micron's a new one that we're looking for technology. Starbucks is also kind of one we're looking for that we haven't been into. Square's a new one for financials. Target, Under Armour, Visa. I mean, those are our core holdings. So if you're thinking about them, interesting. So some of the stocks suck right now. Some of you are surprised, and let me put that up there because that's a good one. Surprised by the stock price fluctuations. I would agree. I mean, yes. In fact, Steve, the fact that you're mentioning that way, and by the way, everyone welcome Steve. He's a newer guy to our group, but yes, I'm surprised by it too. It's shocking. But let's go back to what is causing the price fluctuations. And I'm going to just type a couple in: inflation, war, fear due to crappy news articles. They stretch the truth, right? What else? Supply chain issues. I like that one. Very good, Peter. Boy, Peter and Steve seem to be the two that are really answering all the questions today. What's wrong with you people? Okay, I agree. Are there more we can stick in here? Definitely. Instead of saying bad president, let me just say bad government policies. Because in true, how do I say it? In true fashion, it really doesn't come down to one person. So not necessarily fair, but yeah, poor government policies. They put us in this position. Agreed. Agreed. So let me just go over because I wrote a couple of them here. Disney lost $7 because Netflix had 2 million less subs and a negative new clientele number for the quarter, right? They were upside down. They were expected to have like 2.8 million new subscribers, and they ended up losing 200,000. So is that a reason for Disney to lose 4.5%? Two of you said no right away. Go Disney. Could part of this be from Disney falling out of favor for the crap they tried to pull in teaching kids about sexuality at kindergarten to third grade in Florida? Could some of this be a backlash? Well, yes, it obviously could. But with that said, take a look and take a little notice here that happened weeks or months ago. And it was only when Netflix lost $122 or a third of its value overnight that Disney took like a 4.5% hit. Does that mean you get out of Disney? Does that mean that we bail on Disney? No, of course not, right? If anything, they're just ramping up. So this is the social science of investing. Are you going to get above the curve? Or are you going to follow that curve? In fact, a couple things were mentioned here recently by an individual. Kevin, so-and-so is up significantly. I think the stock was called CAR, C-A-R. And they were correct. I mean, they were totally correct. If you took a look at CAR, C-A-R, it is a stock that is moving. I mean, it's a wonderful movement, right? Let's face it. Taking a look at CAR, which is Avis Budget Group, right? 141 to 314. It's doubled in value. So the question is, do you get into CAR right now after it's doubled, or were you supposed to get in somewhere around the 150s, 160s? This is a push that people are going to be traveling more, right? Well, technically speaking, up here at the top on the RSI, we are touching the overbought line. Can't get above the R1 resistance level. Has a separation probably of 1 standard deviation or more between the 50-day and the current stock price, as well as the 200-day, which basically is saying it's moved too far too fast. Big money, institutional money, have thrown more money at it. The comment was made yesterday, what about getting into CAR? And my comment back was, well, the key is to find these undervalued stocks, which kind of are our core holdings right now, right? Didn't move last year, not moving this year, is to find them down here at this price so we can see a doubling in 3 months. And this is how portfolios double in Hurley Investments so quickly. Not to mention we've added shares on their way down. So 100% investment could be a 200 or 130 or 160, depending on what percentage of shares we added to the account and the position. Fabulous opportunity. It's a fabulous opportunity for a Disney, a Ford, a Visa. Well, not Visa so much, just Disney, Bank of America, Boeing, Baidu, Ford, Facebook, Under Armour, Micron. These are great lows that have 50% more upside, which is why we're in what we're in. And so, yeah, good comment. Can we take a look at a chart on Disney? Let me go to, well, here's Ford. So you can see the highs of Ford up here at 24, 25, 50 down to 15. You asked for Disney. Let me move Disney here. Disney's had these highs up at 190, trading at 124. All-time highs at what? 203, 208 intraday. Some good upside on Disney. That's why we're in it. That's why we're riding it on the way down, looking for opportunity on the way up. Ford. Investing in EV, right? And has a huge backlog. Apple, right? Has a huge cash hoard to fight inflation. And let's put it this way, they also have pricing power. Same thing as Disney. Disney, huge pricing power. They can get through inflation. They can get through chains of uncertainty or times of uncertainty. Credit is an inflation hedge. That's why banks are doing so well, right? Banks widen the spread. Great opportunities here in these places to be at. A great opportunity to pay attention to what's happening. So Steve and who else was here? Steve and Peter, good opportunities to take a look at certain things. James, welcome. All right, let me go back to, I'm going to do Bank of or Boeing, right? Huge backlog of orders. And the last time I checked, it was like 9.4 years. And people are still placing orders, right? James, this is the one that when we get this posted later on this afternoon, you'll probably want to go back and watch and listen to. Facebook, right? Let's really talk about Facebook. Can someone tell me why Facebook also lost $19, $20 or $22 because Netflix had lower numbers? What are your thoughts? Okay. Again, we just went back and Peter, I can tell you're a little ticked off, right? You want to single out Biden, you want to single out Facebook guy. When you say their president sucks, he's really an owner. Mark Zuckerberg is probably the name you're looking for. Yeah, they might be poorly run, but to Mark Zuckerberg's credit, there's nothing that he's poorly run on Facebook yet. He hasn't made a poor purchase. We all gave him crap about spending $1 billion on Instagram. And it's making $1 billion a quarter, right? So again, Facebook shouldn't have been hit $22 like because Netflix had less subs, right? The fact of the matter is their innovation is very expensive. Man, good spelling, Hurley. I mean, they're spending $10 billion on the metaverse, but they're already pulling in over 500 million in revenues. I mean, in 5 years, it'll be paid for. And it's going to increase. There are restaurants that are pouring money into metaverse. So just because their innovation is really expensive doesn't mean you dump the position. We're choosing not to. And again, it comes right back down to what I just showed you on car, right? And I'm kind of going over this because James joined in late, and I think it'll be helpful for James. Car, excuse me, right here. The question was made, we should be getting into car, which is Avis. Well, technically speaking, it's overbought. Technically speaking, it can't get above its R1 resistance level, and yesterday was the comment we should get into car. Easily one standard deviation, which is overvalued. One standard deviation plus some for the 200-day. Big money's already paid into it. So as I'm thinking, I mean, the key is, how do you get into car at 140, 160, 157, not when it's doubled to 314? Why are we in Facebook? Because Facebook's down on this level. And we're in right here and we've doubled shares. So that when Facebook rebounds quickly in a 3-month period and doubles, we're looking at a 200% because of all the protection and things we've done on the ride down. You know what's really surprising? If your stock is losing half its value, and I'm going to put this in this comment here, if your stocks are losing half their value, why isn't your portfolio following those stocks? And it's a simple answer, right? It's a real simple answer. So William says, but Kevin, you have us in individual stocks versus the indexes. Correct. Again, I'm a Warren Buffett follower. If you want to beat the stock market, you can't be in the stock market. Your fees, your expenses to transactions and so forth, you can't beat the market if you are the market. Well, Kevin, what about a fund? You know, it's like 98 of the funds don't beat the stock market ever. And that's partially because they're 60-40. They only beat them by a little bit on the down years. And correct, Peter. We use protection. Instead of waiting out the downturns, the reason why your portfolios are not down by as much as your stock prices are because we use that long put to make up some of the downward movement. We do our best we can to convert those to shares. Let's face it, and I'm going to say it pretty simply. The downtrends suck horribly. But it's pretty neat, in a 2 or 3% up S&P, we can have whole portfolios that are up 10% or more. We understand that. And the reason why we understand it, Peter, is because our own damn money is in with you guys. We have our money doing the same thing. When I say we feel your pain, we feel your pain because our own portfolios have the same freaking positions in them. But we also have a little more experience. I really wish William was here today. We have a little more experience to follow these downward movements because we've experienced these. And it's amazing when you can get a 60, 70, 80% return on a portfolio in a year. That doesn't happen in real life. It'll never happen with your funds and following the indexes and being in it. Go give it a try. The neat thing is, big money's starting to realize this. You know, Keith and I have some really big money coming over. But we're not going to get rid of our little guys. You guys built Hurley Investments. Plus, we're still doing it the same way for ourselves. So that's why we do what we do. All right, here we go. So with all that said, this is the trade. This is what we do more for you guys, for you traders. And again, I'm sorry some of you are down 35% or more year to date in your portfolios. That's the risk with putting on these short-term trades, which is why, in fact, if I can put that in here, I'm just going to write that in there. I'm sorry some of you are down 30% or more in your portfolios, but that is the risk in short-term trading. If you're doing these short-term option trades, that's the risk, which is why that's why I go so far out in time. I do it because you know what? It pisses me off in 4 weeks to be done and to book a loss. I want years for things to come back. I want to admit, and Peter, I know you're new here, I want to admit that, you know what? I don't know what the hell's going to happen in the future. I don't. I spend a ton of research every day because I feel you guys are paying me a good salary, so I should be doing the work. I shouldn't be out golfing or farting around like all these other brokers. I make sure I put in an 8 hour a day work, or basically I make sure I put in 40 hours a week. I don't have to. There's some weeks when the markets are up or when I have protection on. Technically, I don't have to work at all, but I'd feel like a cheat doing that. So I spend my time crunching my numbers. I spend my time working my numbers. I spend my time having longer periods to make these trades so that things can move over a longer period of time. There's no patterns in day trading. There's no patterns in swing trading. There's no patterns in 4 weeks. It's just emotion, news, and movement. There are patterns over longer periods of time. So if you guys think Netflix, excuse me, is being punished unfairly or overly punished, which is true, then here's what I have for you. Here's an interesting position. I'm not sure I'm going to quite put it on just yet. But Netflix was down to like 200 and it's bounced again. In fact, if you look at a chart on Netflix, let's just do that really quickly. What an ugly looking chart on Netflix. I'm going to pop it out here. Today, Netflix has gone all the way down to $211 and it's bounced back up. So it's shown some resiliency. If we look at it on a 5-day, there was its earnings, and boy, it came down on its 5-day to 212. So at that low end, unfortunately, it was lower down here, 211, which is today. We could have a double bottom, but it's not looking to get above that 227-ish range, right? If you feel that Netflix is being unfairly punished, I'm going out to January 2024, a year and 8 or 9 months. My long position, my stock replacement is saying, hey, we have the right to buy the stock at 220. I want a hedge, so my short or credit position is at 300, saying if it gets up to 300, I have to buy at 220. I'm obligated to sell at 300. We have $80 in this trade. When I looked at this morning, the midpoint was about 25.80, so it's even gone higher than that. But if you spent $27.50, you have the opportunity to make $80. It's a 2.5 for 1 risk to reward. And I wonder, you know what? I'm just going to throw it in at 280. In fact, let me see what this is going to cost me. One contract, 280. It's $2,500. I'm going to send it in. I'm going to send in the order. I will get this so you guys can see it. But it's you can make $80 and spend $27.50, maybe $25.80, right? And it's a play that Netflix will make and be worth more money a year and 8 months from now than it is today. That this will be a one-off, that they'll get more subscribers. Next earnings, they might go up $50 instead of losing 122. If they go up $50 from the 120 range, we'll take our trade off for a nice profit. But that's what we're looking for. That was one of those trades that you guys were talking about on, hey, what do you think? I think the order is Netflix, and why can I not get it? There we go. That is our order that we're trying to get into Netflix for, and I can let it fall at the end of the day. Reason why I can let it fall at the end of the day is the markets are not holding their gains. So I would not put a midpoint in for you traders. I wouldn't be putting it in thinking that we're going to have a rip roaring or a rebound. The indexes can't hold their gains right now. At the end of the day, it wouldn't surprise me if the last half hour of the market's open, I get filled. But this would be our trade. This would be our trade. It would be a call vertical where we're going to see a I'll have to print and take a picture of it later, but we're going to say, hey, longer term, we believe Netflix can gain some of its value back. It's not one of my most positive trades I think I would be getting into, but I could see the next earnings it getting a bounce back and getting the opportunity to do pretty good. So if I was looking at a trade in Netflix, it would be right here. And let me work those numbers for you, because some of you guys are thinking, Kevin, I'm not sure, I don't understand. For you traders that like to put a trade in, come on, catch up. Buy to open, the January 24 220 strike, long call. This is a stock replacement. It will end up costing you, well, I don't know, but let's find out. Maybe we're going to go right back and let's edit that position. And let's cancel it, put it back in here. Maybe let's continue it. It's going to cost you between $56.30 to $57. So let's just pick the middle. It's costing you 57, right? Which means at some point in time to technically break even on your long position, Netflix has to trade back up to $277. It's your 220 strike price plus the 57. Your sell to open, the January 2024 300 strike short call, right? This is your hedge where you're obligated to sell, and your obligation to sell gives you $29.60 to $31. Let's just call it $30, right? It's a $30 credit. Debit. So your net debit to your trade, right? 57 minus 30. It's a cost basis of $27. Maximum return is your 220 where you have the right to buy the stock to the 300 where you're obligated to sell it is $80, right? Take 27, divide it by 80. This is your return on investment calculation. 227 divided by 80. Really? Maybe it's 80 divided by 27. Let's do it that way. Yes, it's 80 divided by 27. Potential profit divided by cost basis gives you a 2.96 or a 296% return on investment. And it's long term. You're giving yourself a year and 9 months for it to basically be worth something again. That way you're set and you're where you need to be. So with that said, and yeah, with that said, that's where we're at and that's where we're going to be. So that would be the trade today. It's a Netflix. It's very speculative. So just remember that. Very speculative. But for those of you that were looking for a Netflix trade, that's where you would be at. It's now trading at pricing back in 2017. It's had a ton of growth between now and then, so I get what you're talking about. But again, understand it's a speculative trade. If you're going to be using this trade or doing this trade, you know, understand it's a speculative. You're swinging for the fences, and you got to be smart about it. So just don't forget that. Don't forget that. Be smart, and there it is. I'm going to set it in there. It's one that I'm going to sit and forget about for at least 3 months. So any questions? Any questions for you guys? I'm kind of running out of time. I am going to suggest you guys come back and go through. I had a little bit on here because someone asked about book value the other day. So I've got a link in what book value is, why I look at it. I pay attention to it a lot, especially with certain, I don't know, certain companies that have a high book value is what we do. So just sticking a thought process out there. Any questions? Peter, did you actually just place a trade? Peter, I know you're new. Yes, I just placed a trade. As I said at Hurley Investments, we're doing everything that we come out and that we say, all these stocks that we're in, we have the positions ourselves. We open up real portfolios, we show real positions. Yes, I just placed a real trade. It's not a paper trading account. Again, all those core positions, Steve or myself are in ourselves. We're in caller trades, we're in protective puts. Right now we're protecting for earnings. I might make the suggestion, Peter, you go back in time and maybe go to the myhurleyinvestment.com, go back in time and take a peek and look at this year's commentary, and you'll be able to see what we're doing and how we're doing it and so forth. So yes, my suggestion, go back in time and look at those. James just said something. Give me a second. I need to move things around to read what James said. Perfect. Yes. James actually is making a comment on the Lockheed Martin commentary that we did the other day. So we're in good shape. We're in good shape. We're where we're at, but at times, so let me just put it this way. The best way to say it is if you're always looking for an up month, quarter, or year in your portfolio, I can't promise that to you. But previous to last year, we doubled portfolios in anywhere from a 3 to 4.5 year period of time. I even have a couple people that we doubled their portfolio in like 2 years, 4 months. The reason why is because we had some downswings where we picked up these shares. So as these stocks bounce back, we're doing better than just making up our losses. Peter, under no uncertain terms am I going to guarantee you a return. I can tell you my past performance. Past performance does not guarantee future results. But on the myhurleyinvestment.com, I have everything that's been out there since 2008. We're not worried about a 2008. If you're worried about 2008 type of scenario coming up, inflation, a drop of half of our portfolios in a drop of 50% or more in the stock market, we can make you money during that time period. We're not going to make you a ton of money, but if we have a 2008 where things just drop, you will be slightly profitable for the year. In fact, I would love right now for myself, if I could get a nice, 50% drop in our stock market, that's going to add 100% more shares of stock, which adds a 200% return. Don't call me overly religious, but I'm just going to work some numbers, right? On a $284,000 portfolio with using protection, and these are general numbers, if the stock market loses 50%, Hurley Investments will be break even or slightly profitable. Now here's the catch. We will also double our share counts in these positions. So that when we get 100% return in the stocks, it will be it'll be a 200% return for us because we doubled the share count. So take 284, I'm going to use my own, 284 times a 200% return. You basically take your 284 times 3, right? Itself plus a 200% return. Can't type. Times 3. I'd be looking at, it'll equal 852K for me. And that's where I want to be. That's why I'm doing what I'm doing right now, because I'm ready for one of those years. I'm ready for a 2009. I'm ready for a 2014. It's why we do what we do. Any questions there, Peter? All right, guys, I'm going to run on you. I appreciate you being here. Peter and Steve, welcome to the group. Nice to have some new faces here. Boy, my typical people weren't here today. James, nice to have you. Mary, nice to have you, but you're awfully quiet today, Mary. Dave and David, you guys were also extremely quiet. I really think, in all honesty, as I went through what I went through the start, we're all a little confused. I mean, this Bloomberg 5 things you should know, Mariupol seized, you got to watch out for what's out there. You guys have been pumped for the last 4 to 12 weeks on Ukraine and this and that. And if you work your numbers, you do a little bit of your own research, you can see it just doesn't matter. I'm not saying the lives that are lost in Ukraine don't matter, but no, they truly don't have all the nickel, and we're still going to be building chips. No, they truly don't have all the wheat reserves, and yes, there are going to be some shortages, but wheat's fine because they're not as big as they say they are. You just can't buy into all the crap that's out there. Anyone can post or report anything right now. And just because it's on the internet, it doesn't mean that it's true. So I think we're a little bit quiet today because it's a confusing time in the stock market. It's a confusing time in our world. I get it. Kind of go back down to the basics. When the world gets confusing, you're gonna laugh at me. God, country, and family, right? Go back to some of that military creed. God, country, and family. Spend some time. It wouldn't be bad to have a little extra food storage. I looked at my wife. I got to buy some more fishing gear and some more power bait. And honey, we should have another little worm farm. My wife looks at me and goes, "No, you just want to go fishing." Yes, I do. But honey, if it's going to be Armageddon and you're all worried, don't you want me out there catching fish we get to eat? When life gets confusing, go back to the basics. And I think that's in your personal life. It's in your spiritual life. It's definitely that way in the stock market. When things are confusing, don't make outlandish comments. Go back to the basics. And most importantly, have integrity. Don't bullshit, right? Call it out as it is. You may not like the returns. I'm talking for myself here. I may not like the returns. I may not like where we're at. But I'm not going to lie about it. I'm not going to make up. I'm not going to make up, things to make you guys feel better. I'm going to call it as it is, and that's what we're doing here. So, Peter, Steve, do go back to My Hurley Investments. Goes all the way back to 2008. They're not video recordings for all of them, but you can see notes. Go back in time, and it should give you another level of confidence of what we're doing here, especially when our cycle's in that downturn. It was pretty neat. A couple weeks ago, we had an up day where we were up, 7 to 10% in portfolios. It was amazing, and it was just one nice up day on the S&P. It'll do the same thing here. Good question, Mary. So yes, we are protected through earnings. Our main earnings is next week. Thank you for asking me twice, Mary. I totally forgot. Coke's on Monday. Google, L, and Visa are on Tuesday. Boeing, Ford, and Facebook are on Wednesday. Apple's on Thursday. So yes, we have a pretty beefy earnings week next week. And James, I know you're here. Verizon is tomorrow, James. Micron, Baidu, Disney. So Baidu and Disney are the first couple weeks of May. Square is the first week of May on May 5th, my birthday. Target's May 18th and Under Armour's May 3rd. So this is a beefy week, and then we have a couple more weeks of the first and second weeks of May where the rest of our core holdings come through. So just keeping that in mind. Guys, have a good day. I appreciate you being with me. I do hope this was helpful. We should have this posted by this evening. And yes, for those of you that asked, Mondays was posted. It got taken down. It's now being reposted. And Dave made a little mistake there. He's getting it fixed, and we'll be good to go. So that should be reposted, I would assume sometime this afternoon. Let me call Dave and I'll get back to you. But okay, guys, have a great day. Appreciate your time today. I do hope this was helpful. And James, you came just a little, or Jim Kohler came you just a little bit late. I think that first part's going to be helpful. So maybe find some time tomorrow just to catch the first 10 minutes you missed. It might be pretty helpful for you to understand as well. I think it was David W, excuse me. You also want to catch that first 10 minutes that you missed. Have a good one, guys. Talk to you later. Talk to you on Monday, actually. I'll take care of Monday. And yes, Keith literally went over to Europe with his wife to watch a Sunday Liverpool soccer game. What it's got to be like to have a little bit of cash to go enjoy yourself, huh? Hope he doesn't get COVIDed out and have to stay there 3 or 4 weeks. That'd be rough, wouldn't it? All right, guys. Hey, take care of yourselves. Talk to you later. Bye-bye.